Good. Today we'll be looking at capital budgeting, or widely known as investment appraisal. Investment appraisal. So we can call it capital budgeting. Or the investment appraiser. Good. We'll probably go through why we call it investment appraiser linked to capital budget. In fact, it's a long-term budgeting. Long-term. Yeah. Long-term decision-making techniques. That's a capital budgeting. Now, before I go to capital budgeting, I'll explain that we have to understand some key terms that we did under IAS 16. So let's remind ourselves a little about that. So I'll write two things on the board and then we will try and probably understand it. Now, you have to understand capital expenditure and revenue expenditure. Good. Because you say capital budgeting, it's a type of budget that we normally prepare for what? Our investment, long-term assets. If you want to probably, if coming 5 years ahead of you, it's a long-term, like 10 years, 6 years ahead of you. If you want to undertake any investment, probably need to budget for it, and that budget is what we call capital budgeting. That's the investment appraiser. But before I'll go to that topic itself, let's probably familiar ourselves or remind ourselves on capital expenditure and revenue expenditure so that we can get the capital budgeting correct. Good. So now, okay, now let's see. Someone have a question for me? Good. So capital expenditure. When you talk about capital expenditure, it's simple means expenditure or spending on non-current assets. Good. Spending on what? Non-current assets. That's the capital expenditure. Spending on non-current assets. So capital expenditure means you are spending on your non-current asset, but not all spending on non-current asset qualify to be a capital expenditure. So capital expenditure, simple quote, refers to expenditure incurred to do two items. A, to acquire new non-current assets. New what? Non-current assets. So if you go and buy new machines, new plants, that's capital expenditure. Good. Acquire new non-current assets and even improve and improve. So you acquire new assets or you are improving the existing capacity, or you're improving an existing asset, the capacity of existing assets. So that's the capital expenditure. So acquire new non-current asset or improve existing ones. Improving what? Existing ones. Existing ones. Good. So that is the capital expenditure according to IAS 16, right? When you buy new assets or when you improve the existing capacity. Good. So that is it. Then the second one, when you enter into new business, that's what we are going to probably discuss. This one, IAS 16 did not explain that. So when we did the IAS 16, we didn't talk about new business. Now is the time. When you enter into new business, new what? Business. I like that. New business. You are selling cars, but I want to go and sell probably advanced one, tractor, or I want to enter into a new area. That's it. That's the capital expenditure. Good. In fact, the capital budget that we are going to talk about, it will be this. Entering into new business. So take note for us. Because we are done with the acquisition of new non-current asset and improvement under IAS 16. This one, we've not done it. So, in fact, that is it. For investment appraisal, we are just going to enter into new business. And you have to appraise it. Good. Now, this is the meaning of capital expenditure. Capital expenditure. Now, I'll go to the other one. That's the revenue expenditure. As the name suggests, revenue expenditure. One thing about the capital expenditure is that their benefit lasts for more than a year because their duration lasts for more than a year. If you buy non-current assets, they last for more than a year. It's a long term. Usually 5 years going, 3 years, 4 years, 5 years, 6 years, 10 years. From 5 up to 10 years, and even more than that. So that is it. So their benefit lasts for more than a year. When a company acquires new office building, it will probably serve or benefit them long term, more than a year. So take note. Now the revenue expenditure, that one, they are the expenditure that you incur to just maintain the economic capacity of an asset. Wow. So revenue expenditure, they are the expenditure that you incur to just what? Maintain the economic capacity, the even flow of the benefit. If every year I am receiving 1,000 Ghana from the asset, how do I maintain this 1,000 Ghana? Okay, so I have to probably regularly or routinely, I have to maintain the asset so that I can maintain my 1,000 Ghana. When I improve the 1,000 Ghana, assuming that the asset will last for 10 years. And every year, the asset is giving me 1,000 cedis. Revenue expenditure means I have to do everything possible not to lose this 1,000, to maintain it. Every year, 1,000 Ghana, every year, 1,000 Ghana. So examples, that's the repairs. Repairs, maintenance, fuel, all of this will form part of the maintenance. But if I do something, yes, if I incur expenditure on this asset and now I'm going to receive 1,500 and it will last for 15 years, no more 10 years, then I have improved the asset. That's improvement. Good. So, good news. So revenue expenditure, simple quotes, the expenditure that you incur to maintain the even flow of the economic benefits. The even flow of what? The economic benefit. That's the revenue expenditure. Good. And it must be expense in a P&L in the year that you incur them. All revenue expenditure must be what? Expense in a P&L. So if you see the operating costs, they add up to the revenue expenditure. And then the capital expenditure, you capitalize it. It must be capitalized on the financial position as an asset. So that is it. All the capital expenditure should be on the financial position. Whereas the revenue expenditure, you expense it in the P&L or write it off in the P&L. How big get that? Good. So now that we have probably gotten the clear picture of capital expenditure and revenue expenditure, we will now go into the capital budgeting. Now, your central mind should be on the other type of capital expenditure where we are entering into new business. Where we are entering into what? New business. So we should consider that one most because that will be the topical issue. Good. So that is it. Now, we are going to single this one out and talk about it, where we are going to enter into new business. Okay, so the issue is that, can you just probably pick up your funds and start investing, enter into new profitable area? No, we have to probably appraise it and see whether it will be good for us, whether we are going to get some adequate return on the investment or on the business. So that is it. Good. Okay. So before we will enter or before we will undertake or accept any projects, we have to probably value that product and determine whether in business terms it makes sense. As a rational investor or rational being, a company, you probably have to pick the one that benefits us more. So that is it. So please, most of your exam question, not most, all investment appraisal question is on the new business. Yes, it's on the new business. Good. So that is it. Now, before capital expenditure projects are undertaken, they should be assessed and evaluated. Yes. What are you assessing for? You're assessing for two things. So, what are the criteria for assessment? The criteria for assessment, they are one, what are you assessing? You are assessing for the project that will give us the suitable benefit. Yes, or the suitable inflow. That is it. You're looking for the project that will give us what? The suitable return. Suitable financial what? Return. So one, you are looking for return. So the outcome or the objective of investment appraiser. One, for return. Two, for risks. Yes, because normally return and risks move together, right? Yes. You thought that the higher the risks, the higher the return. The higher the return to, the higher the risks. Oh yes. If the return is high, I can give you a real life example. Take maize good, for instance. The return was very good. It was very high. Likewise, too, the risk too is also high. Yes. So that is it. Now, if you are looking for a greater return, then expect higher risks. So basically, that is it. Now, after considering the return and the risks, then what do? Then we accept the project. So that's the last option. So we will accept the project based on the return and the risks in that project. So that is it. Good. And then the purpose of investment appraiser is to make decision as to which project we should undertake, which project we should ignore, which new business we should probably accept or undertake, or which business we should reject. If we have so many business, like business A, business B, business C, then we have to probably evaluate, assess them on return basis, on risk basis. Yes, and then you choose it based on your level. Probably the return is the most one. So that is it. So we are done. Mostly, organization needs investment appraiser in their capital budgeting process, because if they are going to budget long, like for 5 years, to determine the projects or their investments, their portfolios, they need to appraise all of them and then select, make a decision on them, and that will form their what? Their long-term budget. That's the capital budget or long-term decision-making techniques. So that is it. Good. If you have questions, kindly ask before I now zoom into the area. Good. Before I now zoom into the core topical issue. Good. Now, before you can make decision on which business you should enter into, there are so many techniques that we normally use. So we are going to probably discuss these techniques and then start the game. But that's the main topical issue. So that is it. That's the main topical issue. Good. And then, so it means that the investment appraisal techniques, like the steps, if you want to appraise investment, the steps will be probably, you generate options, you generate potential investment, potential business, new arena. Then what do you do again after generating the potential investment? Then you probably forecast for the risk and the return. Yes, then you evaluate them and then you probably accept and then you implement and then you monitor. So probably that's the process. But I'll go straight to the investment appraiser techniques. So now be with me. We are at what? Investment appraiser techniques. So the methods that we use to appraise investment. So the investment can be entering into new business. Okay, so can you cite example? Yes, everyone should cite an example of new business. So cite example, like your own example. So let me pick it individually, your own business. Oh yes, I'll take that. Buying a production machine to produce books, right? So okay, such as publication. Okay, that's fine. So let's see the method of appraising investment. So method of investment appraisal. Good. Now, basically, there are 3 methods. Basically, there are 3 methods, just that you break the third method into so many components. Probably don't need all of them. So you start 1. Accounting rate of return. That's the method 1. Accounting rate of what? Of return. That's the method 1. Method 2. Payback period. Wow. Then the method 3. It has a nice name. We call it discounted cash flow techniques. discounted cash flow techniques. Under it, we have, so we said that the third method, we have the sub ones. Almighty net present value. Almighty net present value. The most widely used or most preferred one. Then we talk about internal rate of return. Internal what? Rate of return. But there are more. There are more. Can have the duration. There are more. But for the purpose of our syllabus, these are the ones that we have to take notes of. Then you are fine. So these are the appraisal techniques. So by the time you finish this topic, you should know how to use this. In fact, the purpose of your examination, the purpose of your examination is just to know this, how to use this to appraise your investments. Then you are done. So that is it. Good. Good. So if you have any question, please let me know. Let me know. So that is it. So in your exams, combination, any combination goes. Can be accounting rate of return versus payback, or payback versus MPV. Then we move on. So we will start with accounting rate of return. That's where I will start from. And then go to payback. Finally land on what? NPV. Then we are done. So this is a journey. Okay. Now, accounting rate of return. Accounting rate of return. Yes. It's a method that we use to appraise what investment, but it depends, or it uses what profits. This method uses accounting profit to appraise the project. This method uses what? Accounting profit. Unlike the discounted cash flow techniques. Discounted cash flow techniques. So that is it. It uses the accounting profit. So let's single it out and then talk about it. So probably today we will talk about the first two, accounting rate of return and payback period. So that our next meeting, we will now take our time and go through the discounted cash flow techniques. Yes, so that you'll be fine. Okay, so today, let's probably finish this. Accounting rate of return. Any idea? You can share your idea with us if you do have. Good. You can share your idea with us if you do have, or any question so far. Good. Okay, so that's fine. Now, with the accounting rate of return, it's just the method of appraising investment where we consider the profit, the accounting profit. But if you say return, now we saw return on the ratios, right? Return on capital employed. Return. Return means profits. So which of the return are we talking about? The accounting return. That's the profit before interest and tax, but it should be after depreciation. Good. So it's a method of appraising investment where we consider the accounting profit that we are going to generate. That is it. But it's in the form of what? Rate. It's in the form of like percentage. So that is it. So you pick all the profit together and then we average it. Then we divide it by the return. So we divide it by the investment, the capital investment, and then we get what? Then we got the accounting rate of return. It's like a percentage of the investment that we are arriving at. But here it's been expressed as what? In terms of profits. So take note. So accounting rate of return uses profit. We are going to appraise the project, taking into consideration the profit before interest and tax of that project. So put all the profits before interest and tax of that project together, and then you are done. You just express it as a percentage of the investment. So that is it. Now let's see how we will do it. There are two basic formulas. But I'll strike the very first one out for you. Now, accounting rate